Good afternoon, ladies and gentlemen, and welcome to this week's trade review and possibly a look at the week ahead and things that may happen there. I'm just opening up my phone so I can see the questions as they come through, and I'll do my best as always to answer as many of those as I can as we go through this afternoon's session. So just a quick look at the trading that we've had for the week so far. Now, sorry, I'll go back to the Dow at the moment. Obviously, I have a few positions open at the moment. I'm just monitoring the Dow and trying to do that whilst I talk as well. So we're trading, the Dow's getting a little bit soft as we talk, trading down towards the lower levels that we've seen for the last couple of days. Now, the unfortunate part is there were opportunities to get out of both of the Dow trades that I put on today earlier, but I was looking for a little bit more, and still I'm in both of those trades. I've drawn a line here across, as you can see. This is quite a short frame, short time chart, so it's a 5-minute chart, but you can see the low of the last couple of days has been around 26,460, 465. So I'm not really going to be worrying too much about that position, although we're not a million miles away from it now, but looking probably around 26,450 before I start to think about initiating a stop on the two trades that I currently have open in the Dow. One thing that's been quite noticeable during the course of the week has been how much more resilient the DAX has been, and there are some obvious reasons. It's a US-Chinese dispute that's still ongoing, which has its roots back in the trade dispute that we saw a good few months ago, and obviously the reparations with Hong Kong and also Huawei over the last number of months as well. So Germany obviously has no part in that, although it would have some concerns over the a continuing trade war or trade dispute, and so the DAX futures have been far more resilient during the course of the week, and again so today. We've seen probably since the open of Dow futures, we've seen a drop off of something like 150 points and only maybe 25 to 30 points in comparison on the DAX as well. So there are ways, when you notice these sort of discrepancies or the different ways that there are, the two different markets are performing, that you can start to develop strategies where you buy one and sell another, and then try to take advantage of a contraction or an extension of that discrepancy later in the day. Now, I haven't done anything like that this week, but I am still long the Dow and hopeful that we'll see a push back to higher levels. There is still a bit of talk around the markets, or a bit of noise around the markets in relation to added stimulus. It's not going to happen today. The potential for it is probably more pronounced next week. But the more talk at the moment, the more possibility that the Dow futures will rally and get back to the levels that I'm looking for there. Just in terms of the trades for this week, just having a look at those. So there's Monday through Friday. Not so much trading today. You can see the 3 or 4 positions that I have open. One from last night, 3 trades from today. Monday started off, it was a reasonably good day on Monday. It was difficult to make money, lots of small trades with small returns on them, and then unfortunately was stopped out late into the day when the market started to rally higher. And one trade or 2 trades there in particular, both being short the Dow, that caught me out as the market rallied into the afternoon session. The worst day for me, of course, was Wednesday. You can see there in the middle of the block on Wednesday, 4 trades in succession with losses showing there. Stopped out on 3 of the trades. The other one, which was a DAX trade, I just took the loss myself and initiated the stop far earlier than I would normally have done. My rule of thumb, if I'm going to be stopped out 4 times on a day, that's a serious indication that the trading should stop for that day. You're just wrong, your bias is wrong, and your reading of the markets is wrong. And I didn't quite get stopped out on the 4 trades, although there were 4 successive losing trades, and then managed to make some money back towards the end of the day, and ran, I believe, a gold trade over at 1803.5, which I closed out yesterday at 1798.50. Much better day Thursday, 335 pips worth of profit. There is 1 trade left open from Thursday, and then today markets have been quite range bound until just now, and as with yesterday, lots of trades with small returns, not really catching any big movements, and we're seeing a range where 27,000 is definitely the upper limit of this market in terms of futures at the moment, and good support here around the 26,500 level as well, and hoping that will continue. The one thing of note, just going back to look at the trading that we did during the week, and in particular those stops that we saw on Wednesday being triggered on Wednesday, there were a few things wrong with my trading as I went through. There were, I was probably into the trades a little bit too early. The worry was, as we were rallying higher, that we were in the midst of a short squeeze, and the question that I certainly ask myself, and I'm sure you ask yourself as well, is how long is this going to go on? Probably 7 times out of 10 what you see when we do see these sort of rallies pre-US Open is that they tend to be overdone, but there is a point where you have to draw that line and take the decision to stop yourself out of the trades. I know that a few of you did run those trades for a little bit longer. The market then reversed, and I think we went down 350 to 400 points from that level, and all of the trades that I had on would have then turned profitable. Unfortunately, I wasn't of that mindset, and it felt as if there could be more to go. If you do catch one of those 3 out of 10 occasions where the rally continues, it can get painful very, very quickly. So there's a couple of questions coming in there from Mark, just in relation to the gold trade, and it was a gold trade that I mentioned on Wednesday, and it was one that I was going to be holding for a longer period of time, and as I said, I closed it out last night for a profit of about 50 pips, and probably leads on to one of the other discussions that I was going to have today as well, just in relation to gold, and a comment that I made earlier in relation to trading gold on a Friday. Obviously Fridays are not a day that I usually trade a great deal. Every investor is trying to work out whether it's a risk on or risk off weekend. Predominantly it's going to be risk off. What we find then is that people may put or there may be a rotation back into gold, and I think we're seeing that today. So the comment that I made today, so I'll talk about that comment first, was when gold was trading around 1800, I felt an inclination to sell it, but talked myself out of it, or sat on my hands, I think was the comment that I used. And that's just really in relation to the fact that it's Friday, and shorting gold on a Friday is not something that I would encourage anybody to do. And that's why I sat on my hands. Gold then rallied up to about 1809, even possibly touched off of 1810. I think it's probably around 1807, 1808 now. But definitely a rotation into gold, possibly out of equities, people taking some of their positions out of the equities for the weekend and moving that into gold, so that there is some risk, but it's still effectively a risk off trade. So in relation to, so that hopefully is an explanation of my thinking today and why I didn't take the gold trade, and why I wouldn't necessarily take a gold trade on a Friday. Unless you think it's a real quick in and out trade, I don't want to be holding it over the weekend, because you go from having one day or 24 hours worth of exposure to having 72 hours worth of exposure, and increasing the risks that something may occur over that particular period. Back to the gold trade on Wednesday, and the idea that I was going to hold the trade for a little bit longer. I have a belief that gold is overbought at these particular levels, and I do think that we are going to have a big correction in the next few months. The timing of that correction is going to be key, but I think when gold starts to fall from these levels, the moves can be quite aggressive. The one thing that would happened during the course of this week and possibly last week as well is that we've rallied up to 1817 and really struggled to go through that level. So we are in a reasonably tight range at the moment between about 1795 and 1815. So every time I get the opportunity to sell into a rally up towards 1815, I'm going to take that. I was asked by somebody earlier this morning why I'm not buying on dips, and the reason is that I think that the upside risk is quite limited in terms of where the market can move to. I think the downside risk is far more pronounced, because it could be a reasonably aggressive sell-off when we get to that particular level. So that is partly the reason behind the comment about holding the trade for a little bit longer. And I know we rallied away from 1803.50, but I'm comfortable being short gold between 1800 and 1815 in the belief that we are going lower. So it all comes down to your bias and what you believe long term. One other way to play the gold market at this particular time, and I was speaking to somebody about this today as well, was that you can buy out of the money puts. So it gives you the exposure to the downside. You don't want to be paying too much for these, but if you can find a cheap out of the money put, it will give you that exposure that a big movement to the downside will really turn profitable. Equally so, if you believe that the equity markets or the gold market is going to move significantly higher, one of the ways to approach that market is to buy out of the money calls. I don't want to get into a situation where we're talking about selling options. I think you'll find that the margins, particularly for those who are under an ESMA regulated brokerage arrangement, are far too excessive and just not something that should be considered. The problem with buying out of the money puts and out of the money calls is that if you don't get the big market movement, then those puts or calls will expire worthless in due course. So with gold, and you'll see this with me over the last number of weeks and months, I'm much, or I am reasonably happy being short gold, especially at these elevated levels that we see at the moment above 1800. So why was it that particular trade? I just thought on Wednesday that gold was going to break down and break lower. It didn't. It occurred yesterday. There have been a couple of occasions where it has broken down. It broke down from 1817 quite hard, and I thought it was going to break down from the levels on Wednesday. It just took a little bit longer into the close yesterday, and I think it went down to about 1796, 1795. So James is asking, what's the time frame between when you execute and when you text us in the group? The answer is that it's very tight, to be honest with you, James. It is really down to how quick my fingers can post the messages across Telegram. I'd like to say to you that it's instantaneous, but it's not. My typing skills are not those of a 15 or 16 year old kid. They're of a 53-year-old man who's not used to using a phone quite that way. So we're looking at ways that we can refine that so that it is a bit quicker. I know by looking at the prices, sometimes the market can move fairly quickly after I've taken a trade. Sometimes it moves in my favour, sometimes it moves against me, in which case you get a better feel than I would have done at that time. So there is a certain amount of swings and roundabouts in that, and equally so with the exit on trades as well. So sorry, I'm just trying to get back to another question that was here a minute ago. So Stuart's been on, and he has the opposite opinion to me, and that's fine. You know, look, the one thing about markets is that you do need different opinions, otherwise nobody would ever trade. So Stuart sees gold moving towards 1896, and I have some friends who run gold funds who are actively selling gold positions, and they would like you to believe the same. But it's definitely a case of differences of opinion, and there's a lot of analysis out there. Got some from Goldman Sachs a few weeks ago, which saw this rally up to 1800, which again sees gold going higher. I think breaking through that 1817 to 1820 area is going to be the key area for me. It's struggled so far. I think if you go back and you look at these highs, they go back to about 9 or 10 years now. The last time that we were trading at these levels. So it is going to be quite a significant breakthrough that's required to get through this particular point. The coronavirus situation, look, I'm as worried as everybody about it. I think there are going to be continued outbreaks. There's going to be continued areas of containment. I think the thing that's a big issue at the moment is the differing response in different locations. People seem to be taking it for granted, unfortunately, a little bit in the United States, whereas I live in Ireland, where it's very well contained, but there are fears of further outbreaks, and then you have the UK, which I think is somewhere between the two of them. I don't think we're going to see a massive sell-off in the markets unless unemployment levels are still pretty poor. 32 million people unemployed in the United States. Unemployment levels aren't good in the UK or anywhere else. There is going to be an economic impact if we do have further outbreaks of coronavirus, but the markets seem to be surpassing or overseeing most of that, and looking ahead to positive indications in the future. And whether that's right or wrong, only time will tell. But I would be concerned about the coronavirus situation. I think we have the election in the US coming up, so there's plenty of negatives out there. But with the way that markets have moved over the last week in particular, there is potential for upside still with this market. The move on Wednesday, or the strength of the move on Wednesday, was probably, for me, the biggest indication of that. And going back to the trades that you see in front of you, I've mentioned this in previous weeks when I'm developing bias in terms of the way that I'm going to approach the market, and it typically tends to be one-sided. On Monday I was short the indices again. Same thing on Tuesday. On Wednesday, you can see it's quite pronounced early on. All of the trades from an index perspective are to the short side. We then have that drop off, and I'm looking to buy on dips. It was the buying on the dips that enabled me to claw back some of the losses from earlier in the day. And then in the last 2 days, on the back of that big move that we saw on Wednesday, equally so, I'm looking to buy on dips, because there is some latent buying in these markets around these levels, and I think it's probably better supported at this particular point than I would have expected, and that's for the reason for the change in approach at this particular time. I've just about run out of time, so thank you very much for joining me, and if there are any further questions, I'll get back to them during the course of the day. Thank you very much.